applying bonds to FX. So as you learned in the previous lesson, what is a yield to maturity? What is a coupon rate? Of course, what is defaulting on the debt? Of course, that's the absolute basics of what you need to know, but it's all well and good knowing the basics of what a bond is and what are the components, but how do we apply it? And especially during this type of market, in 2023 especially, and it was a massive theme throughout 2022 as well, to be fair. So how do we apply it to FX? This is very, very important. So of course, the sort of bonds you want to tend to be looking at is as follows. So we'll look at the US, of course, the US Treasuries. We'll also could look at the bunds as well, which is the German. We could look at the gilts, of course, which is the UK bond yields or bonds. So the ones I typically look at are the 2 years and the 10 years. Those are the most sort of on in regards to a time horizon that most people look at. And we'll go over another video in regards to what 210 spread is. You might have seen news about it in 2022 about how it inverted, and then that's a recession indicator, etc. So we'll get over that in another video, but for now we're just going to look into how do we apply bonds basically. So yeah, twos and tens are the kind of ones I look at. Of course, the 2 year yields. So if I just put that line, 2 year yields typically indicate short-term hawkish or dovishness in the central bank. So they're much more prone to the rhetoric of a central bank, because of course the lower the time frame, the more volatility it has, right? If you look at like a 30-year bond yield, you'd see there's not as much movement in comparison to a shorter end like the 2s or the 1s or the 6 months. So yeah, 2 year yields it is typically used to just indicate the sort of reaction function of the central bank. Are they hawkish? Are they dovish? You tend to see larger movements in comparison to also the 10s. And the 10 year yields just give a much more long-term perspective on how the market sees the economy itself within the country, but also it allows them to just to gauge the sort of interest rates are what is expected, shall we say, for it to be in the future. So 10 years, you could flick through that, just have a look, but it gauges long-term views on interest rates, or let's just put monetary policy. So how do we apply this now? So it's all well and good, like I said, understanding what a yield to maturity rate or what a coupon or what a default is, but how do we apply it? So remember, 2s and the 10s are the kind of ones you can look at. You can look at the 5s, you can look at the 15s, the 20s, the 30s, but typically most people use the 2s to indicate, let's say there's a Fed meeting tomorrow, for example. How does the 2 year yields react? That's what more people are concerned about. And also they'll look at the 10 year yields as well to gauge that long-term view on where investors see policy at. So how do we use it? So if you go on TradingView, if you just type up US 10 or US 2, O2, make sure it's clicked on bonds. You don't have to, you can put it all, but typically I just put that if I'm looking for bonds, just so it's easier to see. But this is the one you want when it has Y. So this is the yield. This is just the price of the bond. So typically, it's important to note here. So if I just zoom out here. So typically, what happens is that when bond yields are climbing, the price of the bond is falling. So like that example I said in the presentation about that $100 coupon or $100 price of the bond, shall we say, if you buy it at a 2 year yield or a 2 year sort of maturity at, let's say, 2%, then we understand that, okay, well, it cost 100 to get in, but as that yield is climbing and climbing and climbing, because maybe central bank is super hawkish, so people sell the bonds as the yields are climbing because of the hawkish rhetoric in the central bank, the actual value of the bond is collapsing as well. So although they may be being paid as 2% every year for 2 years, if they buy a 2-year maturity, then we understand that, okay, well, at some point, the price on the bond is going to be so cheap that the yield on the bond that they bought it at isn't going to pay back, or isn't going to pay back the loss that they've made on the the fall on the price. So that's the kind of correlation you see. So this is why you look at the 2-year Y at the end. If you put US2 O2 and then just enter, that's the price of the bond. If you look at the O2Y at the end, that's the yield of the bond. So that's important as well. So like GB on trading view, it's GB and then O2Y, similar to the German, it will be GER or DE, sorry, I believe it is 10Y or O5Y or O1Y. So yeah, bond yields are climbing with the price of the bond. Like I said, that $100 sort of example, it's falling. So as the yield's climbing and climbing and climbing, the reason for that is because, so as the yields are climbing, investors are asking for higher yield on the bond because it's risk. As it climbs and climbs and climbs, it becomes riskier, right? And people are, or as the, shall we say, when the bonds. So as the bond prices, so I'll just put bond prices fall, investors typically ask for higher yield on the bond. Okay, so that's the kind of rule of thumb. As bond yields fall, or bond prices fall, sorry, so like that $100 example, the investors typically ask for a higher yield on the bond, just to offset that, because they're taking on risk, right? So that's the kind of viewpoint you want to be looking at in regards to this sort of market. Also to note there as well is in times of unrest, bonds, so treasuries, are seen as a safe option. So this is why when you see, the kind of, we'll show you a live example on the chart, but during COVID, how we saw bond yields collapse because people were buying bonds as that safe haven option. So bonds prices and bond yields are completely separate to each other. If you read like an article and they see, bonds are expecting to climb, or you see that a institutional bank says they're long the front end of the bond market, it means that they're buying bonds, so they're expecting yields to fall. So that just have to be careful. Unless they say yield at the end, they're typically just talking about the price of the bond. So bonds are seen as a safe haven or a safe sort of option. It's basically backed by the US government and by the government of whichever country you're looking at. So it's seen as pretty safe, right? And the most, shall we say, countries don't really default on their debt unless you've got extremely large amounts of deficit. For example, like Greece, that's why their bonds are classed as like trash in quotations, is because they're extremely unable to pay that because they haven't got that enough money to pay out the price. So how we see it as is, bonds are seen as that safe haven. So in times of unrest, people buy bonds, and that's viewed as that climb in the bond price, and that's reflected in the lower yield. So typically, when a central bank is hawkish, we tend to see yields climb. And of course, vice versa, when you see the central bank dovish, like what you've just learned in the monetary policy presentation, when a central bank is dovish, that's typically reflected from a weaker currency. And of course, in this example here, when yields are climbing or the central bank is hawkish, we tend to see yields climb. And of course, the reasons for that is because the yields on existing bonds that are issued out by the government are obviously becoming less attractive because investors are able to earn higher yields on newly issued bonds. So as bonds are being issued out, they're obviously, investors are demanding more yield because it becomes riskier to own it. Because that, like we learned, or as we know, when the yields climb on a bond, on that Greek bond example, as the yields are climbing, it's becoming more and more and more likely that the central bank or that the government is going to default on that issued bond, and that's why they typically ask for better yields. Just think of it logically. If I was going to tell you something, say, yeah, this is really, really risky, but I'm only going to give you 1%, you'd say, no, I don't want that. I want that 5%, I want 6%, I want 7% returns. You're not going to invest into something that's really risky with really low returns. So it's a similar scenario here. So obviously when a central bank is hawkish, it signals that it may raise interest rates in the future, of course, and it creates an expectation of higher yields anyway. So it's always important just to note that there. So this is why, of course, bond yields tend to climb when the central bank is hawkish. So that's the kind of reasoning why that happens. And of course, on the flip side there, if the central bank is dovish, like we know, it's typically reflected by them potentially lowering interest rates. And of course, the yields fall as a vice versa proxy to that. So in this example here, we're going to be looking at the hawkish sort of rhetoric of the central bank. But that's the kind of reason why we see that. So the way yields are calculated is as follows: is dividing the bonds coupon payment by its price. And of course, if the coupon payments remain the same, but the price falls, the yields increase, of course, by just going back into this sort of mathematical sort of equation there. So dividing the bond's coupon payment by its price. So of course, the coupon payment, if you go back to the basics of bonds, you'll see what a coupon payment is there. So that's the kind of sort of thing I just want you to screenshot there. So just screenshot that, write it down in the notes, however you like to learn. But let's just overview this before we look at a sort of example on the chart. Bond yields are climbing, the price of the bond is falling. Bond prices fall, investors typically ask for a higher yield on the bond because obviously it comes at a risk. Bonds are seen as a safe haven or a safe option, if you will, because obviously it's backed by the actual government of the economy itself. In times of rest, of course, people buy the bonds. We're not talking about buying yields here, we're talking about buying the bonds. And of course, like we know, the bonds, people are buying the bonds, buying. What happens to the yield? It falls. Typically, when a central bank is hawkish, we tend to see yields climb naturally, and of course, vice versa to that is obviously the dovish central bank. Yields are calculated by dividing the bond coupon payment by its price. And finally, if the coupon payments remain the same, but the price falls, the yields climb. So that's the kind of the reasonings as to why yields are basically calculated there. So how do we basically apply this to a FX chart? So as you can see, this is the US 2-year yield. This is the yield on the right, so 3.96%. So if you bought a 2-year government bond, you would be paid out 3.96% every year for 2 years. And then after that, the government buys it back at the current market price. So if let's say they issued it at $100, the price then falls to 80, they buy it back at 80, you've then lost $20. So that's the kind of, that's why investors and traders are more concerned about if there's a large amounts of falling in the bond prices. It is worrisome thing because maybe the coupon or the yield can't cover the fall in price, and that's why they tend to jump out of that bond as soon as they see any sort of rhetoric, or they buy up the bonds in sort of this perspective here. Because like we know, if the yields are falling, that's typically seen as people buying the bond in times of unrest, for example, or they're expecting the Fed to turn around, become a bit more dovish, etc. So if we just get up the DXY, and I'll just put it on the right here, so DXY, this one here. So if I just grab this, just delete this and this. So use the crosshair. So this sort of dotted line crosshair is obviously the time in which it's moving. If we go right the way back to when we saw yields climbing. So as you can see here on Monday the 20th, this is just a random date when we start to see climb in the bonds. Just remember you obviously have to note as well, it's not a one-to-one correlation, whereby if you see bond yields climbing, you're just going to instantly think that maybe the dollar is climbing as well, but it gives you an indication of potential dollar strength to come in the future, and vice versa. We're seeing yields fall, that would indicate potentially we are starting to see the dollar expecting to fall as well, because the rhetoric is starting to change. That's obviously something to note there. So yeah, the bond yields are climbing here on the left. Obviously this is the DXY. The reasons for the massive moves to the upside, because also what was happening in euro at the time, you know, they had a bunch of weak data. The ECB was super dovish still in comparison to the Fed. They were now turning more hawkish. The data was far greater in the US as well. So it's just all pointing to buying dollars, selling the euro, and therefore euro dollar pushed higher, pushed lower, sorry. Euro dollar pushed lower. So as we can see here, how do we use it? So we just use it as a gauge of monetary policy, basically. So both on the daily, so if I put this in the daily time frame as well, just so we can be a bit more up to date. So as you were expecting yields to climb, let's say data's really started to turn, let's say we got down to this stage down here, we started to see data really start to turn around. You know, we start to see it bottom out. PMI started to bounce. We start to see retail sales climb. We start to see unemployment rate fall. We start to see stronger NFPs. We start to see a bit of inflation as well. That would indicate maybe at some stage in the future, the central bank is going to turn hawkish. And as a result, then you think, okay, well, now we're going to expect yields to climb. And as a result, that just allows that currency to strengthen ever so slightly. Of course, you have to look elsewhere as well. What's happening as a theme of the market? What's happening if there's any sort of risk on, risk off type of events like wars, for example, COVID, etc. But overall, briefly at this stage, we knew the dollar was going to strengthen anyway. So how do we use it? Just use that as an indication. So if you're seeing a much more up-to-date example, so if I just zoom in here, if you're expecting, like for example here, we saw yields absolutely collapse because people were buying up bonds when we had that SVB crisis and Credit Suisse. So like what we learned at the start, people see it as a safe haven. So when there's times of unrest, people buy bonds and that pushes the yield down. So as a result of that, that's just, as you know, that correlation with regards to FX, the yields are falling, that typically indicates a weaker currency for that domestic sort of overview. In this sense, obviously this is the US, so it's kind of a global bond yields fell in conjunction. But as you know, at the time of recording this anyway, it's obviously in April 2023. You're more than welcome to read or watch through the videos speaking about, you know, the SVB crisis around mid-March time when we were speaking about that 2023. So yeah, at the moment we are currently at 3.96%. If, like for example, today we did see, or yesterday, sorry, if we're going by the sort of this candle here on Wednesday the 12th, we did see a weaker CPI print, which came in weaker. We saw the yields fell, because what does that mean? If inflation is falling, that typically then indicates that maybe the central bank in the future is going to be more dovish. So people are buying bonds then at the highest price they can to then hold it for a 2-year maturity. Of course, if you're looking at a 10-year, so for a US 10 prior, it's less than that. But we'll go over what a 210 spread is in another video. But typically, an inversion is not a good thing. And at the moment, we are inverted, meaning the 2-year yields are higher than the 10-year yields. So yeah, at the moment, we're at 3.4%. So they kind of all follow suit. If the 2-year yields are falling, we tend to see most of the time 10-year yields falling as well. But if we start to see more, if the rhetoric of the central bank is set to change imminently, the 2-year yields will fall far greater than that 10-year yield. And that is typically reflected by a weaker currency as well. So that's typically how you would use it. So if I then get up the gilts market, so GB, O2. So this is the gilts market, which is the UK bonds, basically. As you can see, most of the central banks' yields climbed because, as we know, they all hiked interest rates. They all pulled liquidity out of the market. So why, though, didn't we see GBP USD climb? So you may have this sort of indication here, whereby yield on the bond has climbed, but the price, the currency price, shall we say, has fallen. So GB02Y. So if I zoom out, yields climbed here, but the GBP USD started to fall. So as you can see here, look at the sort of dotted line. This climbed up, the currency fell off. So you kind of use bond yields as an additional tool. Yes, we know if bond yields are climbing, it typically indicates a stronger currency, but you don't just look at the bond yields and indicate, okay, I need to buy the currency. You need to look elsewhere. So at that stage, of course, all throughout this issue, the UK's economy was collapsing. You know, it's collapsing, but the central bank had to stay hawkish because of inflation. And that's why the yield just climbed. So like I said, use it as a gauge of a currency in general. Then look elsewhere. Okay, what is the UK unemployment rate doing? What's the fiscal policy doing? I.e., what is the government doing in regards to taxes, etc., and their spending? What is the sort of risk sentiment at the moment? Are we heavily risk off? So as we know, the pound is a risk on currency, so it wouldn't really pose well in that sort of environment anyway. So you got to look at the broader sort of aspect and the broader economy, but use the bonds as a sort of gauge of a rhetoric of a central bank. That's how I tend to use them. So I'll go like this. So I'll be like, okay, well, US02Y. Well, you have to think what's happening fundamentally at the moment. We're starting to see turnaround in bits of data from the US that indicates maybe the Fed is expected to become a bit more dovish in the imminent future, shall we say. So now all I'm just thinking now is we want those yields to start falling because data is now starting to go from peaks to now then contraction. So we're roughly around this area here at the moment in regards to US economic data. So now all I'm thinking is, well, okay, great. Now I'm just expecting bond yields to start falling. That's just an additional sort of confirmation, if you will, of now maybe we are going to expect a weaker dollar trend to continue. Does that mean, though, if we start to see the government, the bond yields in the UK start to fall because maybe the BOE is going to start turning dovish soon, that we're going to be bearish the pound? I mean, that's definitely a correct way of thinking, but you have to think of the sort of broader aspect as well, i.e., if I'm bearish GB or if I'm bullish GBP USD at the moment, you know, remember to think about the broader economy and the broader bits of data. The UK isn't in the greatest of state, but I'm going to be bullish the pound, against specific currencies because the other side of the trade, i.e. the US dollars, are far worse off in the future than they are in the UK. So therefore, my thesis would be GBP USD upside, for example. So you got to think of like I said, just use that sort of tool in your toolbox, and that should just help you just understand it a little bit more easier. But in the next video, we'll be talking about the 210 spread. You might have, like I said at the start, you might have heard about it inverting throughout 2022, and that typically reflects most of the time a contraction or a recession in the economy itself. So that is it on just the basics of bonds. Remember, just to use it as a sort of gauge of monetary policy, a gauge of sentiment as well, because if you're starting to see, let's say, I don't know, there was a massive global event again, let's say another virus, do you think people are going to be selling their bonds, pushing yields higher? No, they're going to be buying bonds. Remember, they're seen as a safe haven. So they're going to be buying those bonds, the yields are going to start falling. So I'll just use it as one, gauge of monetary policy and how well, you know, the investors see the sort of the sentiment of the economy, and two, risk sentiment as well. is also something very noteworthy there. So if I just scroll back, like I mentioned, throughout 2020, people were buying bonds. As we know, the inverse correlation happened, right? So people buying bonds because it's seen as a safe haven. The yield obviously naturally falls in that sort of environment. It then bottomed out at some stage. Obviously, this is the UK, but it's the same everywhere. So I've put USO2Y. It's the same here. In actually a much more exacerbated sort of move there. But as you can see, people were just buying bonds, buying, because they understood the yield were going to fall, so they wanted to buy the bond at high enough premium. So if I were going to say, well, I'm going to offer out you this sort of coupon here, I promise to pay you back 1.4% every year for 2 years. And then you come to me and say, or you're expecting, the company to go into sort of massive liquidity issues, so they're not able to pay back the highest premium anymore. The price of it falls, and now it's going to, oh well, you got to buy it now, but I'm only going to pay you 0.4%. Similar scenario here, where they actually saw the economy starting to fall, people buying up bonds anyway as a safe haven, so they'd rather cash in and buy bonds now at a better premium. And that's why we're seeing, as of recently, people buying bonds here, because that's that safe haven status, if you will. And also the understanding throughout this area here is that now the Fed may need to start to turn a little bit more dovish. And this is just swings of data. If data suggests a bit more hawkishness, we tend to see yields climb. If we tend to see data, for example, yesterday we had CPI came in weaker, especially the components behind CPI came in weaker, especially shelter and services. That indicates maybe the Fed now is going to give it a bit more breathing room and actually able to hold earlier than anticipated. So that just gives me an overview of a sort of currency and a sort of toolbox, if you will. So that is it on bonds. I will see you in the next video.